You have 10 minutes to justify a $20 million valuation with nothing but a raw prototype, a slide deck, and the belief that your company can become enormous. The air in the boardroom is freezing, but you are sweating through your suit. Across the table, 5 venture capitalists are studying your financial model like they are searching for the exact point where your dream collapses. One of them closes the deck. You are pre-revenue. Your burn rate is rising, and 3 larger companies could copy this product in 6 months. Why is this worth $20 million? This is the question you were not prepared for. And now, your startup either scales or dies. Welcome to the high-friction world of seed round funding, where investors are not simply buying part of a company, they are buying a future that does not exist yet. At this stage, your product may be unfinished, your team may be small, your revenue may be inconsistent or completely non-existent. So the pitch is not about proving that you have already won. It is about proving that you understand the problem, that your solution can become defensible, and that your team is capable of turning uncertainty into growth. You take a breath and return to the beginning. The company exists because businesses are losing millions of hours to a slow, fragmented process. Their teams move information between outdated systems, manually verify every step, and accept delays as normal because no one has built a better alternative. Your startup has created an intelligent infrastructure layer that connects those systems, automates the verification process, and reduces work that once took several hours to a few minutes. That is the problem slide. But investors have seen thousands of problem slides. The real test is whether the problem is painful enough for customers to pay for a solution. You explain that your early design partners are not using the prototype because it looks impressive. They are using it because the existing process costs them money, creates operational risk, and prevents them from scaling. That distinction matters. A nice-to-have product becomes the first expense cut when budgets tighten. A mission-critical product becomes part of the company's infrastructure. The lead partner leans forward. How many of these design partners have signed contracts? You answer honestly. None. The room becomes quiet. This is where inexperienced founders begin to exaggerate. They call informal conversations partnerships. They describe free trials as customers. They present email interest as revenue. You do not. Instead, you explain the evidence you actually have. 12 companies have completed product interviews. 7 provided access to their existing workflows. 4 are actively testing the prototype. 2 have agreed to begin paid pilots once the security requirements are completed. That is not revenue, but it is a pattern of increasing commitment. And at seed stage, investors are looking for evidence that each step makes the next step more likely. The next question arrives immediately. What stops an established company from building this? This is the moat question. A feature is not a moat. A clean interface is not a moat. Even strong technology can be copied if a competitor has enough engineers, capital, and distribution. So you explain that the defensibility is not based on one feature. It comes from the architecture, the data integrations, the workflow knowledge collected across customers, and the speed at which the system improves as more companies use it. Every integration makes the platform harder to replace. Every workflow creates more proprietary operational knowledge. Every successful deployment lowers the cost of onboarding the next customer. The investor interrupts. So your moat does not exist yet. Correct. At seed stage, many moats do not exist yet. What matters is whether the business has a credible path toward one. You are not claiming to own an impenetrable fortress. You are showing them the blueprint for how that fortress will be built. Now they attack the market size.
Your slide says the total market is worth billions. One partner shakes his head. Every founder says the market is worth billions. How much can you realistically capture? This is where the difference between a large market and a believable business becomes clear. A top-down market estimate might begin with a total global spending in your industry, but investors want a bottom-up model. How many customers can you actually reach? What will each customer pay? How long will sales take? How many salespeople will you need? How quickly can the product expand inside each account?
You explain that the initial target is not every company in the world. It is a narrow group of mid-sized technology businesses with complex internal systems, urgent automation needs, and budgets large enough to buy quickly. There are approximately 3,000 companies in that first segment. At an average annual contract value of $40,000, the immediate serviceable market is $120 million. That is only the entry point. Once the platform proves itself, it can move into larger enterprise accounts, adjacent industries, and additional workflow categories. The strategy is focused first, expansive later. Now the conversation turns to valuation. Why should a company with no revenue be worth $20 million? The uncomfortable truth is that early-stage valuation is not a precise scientific calculation. It is a negotiation shaped by the team, market, product progress, investor demand, comparable deals, and the probability of future growth. You are not saying the startup is worth $20 million today because of its current cash flow. You are arguing that the progress already made, combined with the size of the opportunity, justifies selling a small percentage of the company at that price. You are raising $3 million. At a $20 million pre-money valuation, the investors would own roughly 13% after the round, before considering any option pool changes or other adjustments. That number matters. Raise too little, and the company may run out of money before reaching the next milestone. Give away too much, and the founders may lose flexibility long before the company becomes valuable. The goal is not to maximize valuation at any cost. An unrealistically high valuation can become a trap. If you raise at $20 million but fail to grow into that price, the next round may happen at the same valuation or lower. That can damage employee morale, reduce founder ownership, and signal that the company has lost momentum. So the valuation must be ambitious enough to protect your equity, but credible enough to support the next financing round. Then the investors examine your burn rate. Your company is spending $180,000 every month. You have 6 employees, cloud costs, legal fees, product development expenses, and security work still ahead. The partner asks, "Why do you need $3 million when you could operate more cheaply?" This is not really a question about expenses. It is a question about judgment. Investors want to know whether you understand how every dollar creates progress. You walk them through the use of funds. 45% will expand the engineering team and complete the production platform. 20% will fund security, compliance, and infrastructure. 20% will support customer acquisition and the first repeatable sales process. The remaining 15% will cover operations, legal costs, and a controlled reserve. At the current plan, the round provides approximately 16 months of runway. But runway alone is not the goal. Milestones are the goal. By the end of that runway, the company must achieve a production-ready product, 10 paying customers, $1 million in annual recurring revenue, documented retention, and a repeatable path for acquiring new accounts. Those milestones are designed to make the next round possible. The money is not being raised to keep the startup alive. It is being raised to remove the biggest risks in a specific sequence. First, product risk. Can the technology work reliably? Second, customer risk. Will companies pay for it? Third, retention risk. Will they continue using it? Fourth, growth risk. Can the company acquire customers repeatedly without spending more than those customers are worth? A strong seed plan does not pretend that risk has disappeared. It shows how the funding will convert unknowns into evidence. Then comes the most personal attack. Why are you the team to build this? Your co-founder was previously an infrastructure engineer. You spent years working inside the industry you are now trying to change. Together, you experience the problem directly. But experience alone is not enough. The investors need to believe that you can recruit, sell, adapt, and survive. Startups rarely fail because the founders could not describe the original idea. They fail because reality changes and the founders cannot change with it. So you explain the mistakes already made. The first version was too broad. Customers did not understand it. The team cut half the features, focused on one painful workflow, and rebuilt the product around what users were actually requesting. The new version is less impressive on a slide, but far more useful in practice. That answer changes the energy in the room, because investors are not searching for founders who have never been wrong. They are searching for founders who learn faster than the company runs out of money. The lead partner returns to the original question. Why is this worth $20 million? Now you are ready. You tell them the valuation is not based on the prototype alone. It is based on the severity of the problem, the early customer commitment, the size of the entry market, the expansion opportunity, the team's direct knowledge, and a financing plan tied to measurable milestones. You are not asking them to believe that success is guaranteed. You are showing them that the upside is large enough and the plan disciplined enough to justify the risk. Then you make the ask. We are raising $3 million to reach $1 million in annual recurring revenue, prove retention across our first customer segment, and build the infrastructure required for enterprise expansion. We are looking for an investor who can help us recruit key talent, navigate enterprise sales, and prepare the company for the next stage of growth. That final sentence matters. You are not simply asking for money. You are selecting a long-term partner. The wrong investor can push the company toward reckless growth, force premature hiring, create pressure to sell too early, or become hostile when the original plan changes. The right investor can introduce customers, recruit executives, guide future fundraising, and remain calm when the company hits a crisis. The pitch ends. No one speaks for several seconds. Then the lead partner asks the final question. If we do not invest, what happens next? This is where desperation destroys leverage. You do not say the company will die. You explain that the team will continue running paid pilots, reduce discretionary spending, and speak with the remaining investors in the round. You want this firm. But the company's future cannot depend on one room. The meeting ends without a decision. That is normal. Most funding pitches do not finish with a dramatic handshake. The investors will discuss the opportunity privately. They will contact customers. They will investigate the market. They will study your background, your numbers, your legal structure, your ownership table, and every claim inside the deck. If interest continues, they may issue a term sheet outlining the valuation, investment amount, board rights, liquidation preferences, voting provisions, and other conditions. And this is where founders must remember that the highest valuation is not automatically the best deal. Control rights, investor protections, dilution, and future financing terms can matter just as much as the headline number. 3 days later, your phone rings. The firm is willing to lead the round, but they want a lower valuation, a larger option pool, and a board observer seat. The pitch is over. The negotiation has only begun. This is the reality of seed funding. You are selling part of a company that is still becoming what you promised it could be. Your prototype proves that something can be built. Your customer evidence suggests that someone may pay. Your financial plan shows how long you can survive. But your judgment is what investors are truly evaluating. Can you separate confidence from fantasy? Can you defend the vision without ignoring the risks? Can you make hard decisions before the bank account forces you to? Because when you enter that boardroom, the investors are not only asking whether the idea can become a global company, they are asking whether you can become the founder capable of building it. And for 10 freezing minutes, every answer determines whether your startup receives the capital to scale or becomes another brilliant idea that never escaped the slide deck.